Hello, it's Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for December 21st of 2025. Welcome to the final chart pack of the year, and hope everyone's had a wonderful holiday season thus far, and be safe if you're traveling, and hope everyone has a wonderful remaining holiday season and new year. So let's get started with some of the detail and the data that we've got. We've got some headline inflation numbers to talk about. This is the November data that we just received. Maybe as we're scrambling kind of slowly to get back to normalcy after the government shutdown. But you can see here that the headline inflation was a little bit lower than expectation. We had month over month, it was up 13/100%. And year over year, the number was 2.7. The estimate there was just a little bit over 3%. You can see maybe a gradual downtrend, even though it's been a little sticky, and we've had some upticks in inflation lately. Latest data point was clearly better than expected. If we go look at core inflation, again, same issue there. Year over year number was 2.6. The estimate was for 3%. And month over month, it was 0.08% there. So you can see also trend in core prices a little bit more pronounced on the downside over a multi-year trend, less perhaps noisy with the notable upticks here in the headline number, but trending in the right direction, but obviously something we want to continue to maintain our, something that will continue to hold our attention. So in looking at additional components of the inflation picture, we've got super core inflation, which is a much more narrow band of items that tend to have much more influence over inflation. That number came in here at 2.7 on a year over year basis. And if we look at that over 6 month annualized, 2.7, and then 1.5% if we just look over the last 3 months as we've had that notable downtick. And then here, as we showed you in the previous chart that we had, for a number of months that was moving a little bit higher, but again, inflation, when you look at it on a trailing basis, on an annualized trailing basis, clearly in the right direction. We have core goods inflation that we see here is trending down. This is year over year in the black line. We've got the 3 month annualized data. Again, a trailing annualized number that just looks at the last 3 months, which is helpful in many respects. You can see that is in a downtrend. And if we slide over here to services inflation, you can see that we had a lot of services inflation over the years to match goods inflation, but we saw some relief in goods inflation much sooner than we did in the service side. But again, same situation here. We've got those both on the year over year number here in the black line, as well as the annualized number, each moving down. Now we have the Atlanta Fed inflation expectation number, which is also very important. This would be a soft indicator, if you will, or soft data. This is just an estimate for what people expect. They're looking about 2.25%. This is the unit cost expectations via the Atlanta Fed. So again, witnessing that multi-year downtrend here with the kind of the pickup around the tariff tantrum here, but heading into 2026, the forecast is actually looking relatively decent. Now we'll look at some regional Fed data. We've got the Philly Fed, first and foremost. You can see manufacturing index still in contraction. Just to remind you that everything below zero here represents contraction. Everything above it represents expansion. So we had a little bit of a downtick, and not egregiously so, but you can see that we've had a fairly sluggish couple of years here from the Philly Fed within the manufacturing sector. Green shoot here, perhaps on the new order front, we had a slightly expansionary number to match a few of the data points that we've had here. But as you can see over the last few months, it has been relatively noisy. But we're really kind of hugging the flat line here with overall manufacturing looking a little bit lower. Now we've got the Kansas City Fed composite index. Moving lower, but still marginally positive. You can see that we've kind of like dug ourselves out of that doldrum there, but that we saw ourselves for a protracted period of time when we were kind of honestly going through a manufacturing recession of sorts. This is a composite number. Again, still positive, but less so. When you look at new orders here, we've got current new orders in the black line. That had slipped into negative territory, and it looks basically flat for the most recent reading here. Future expectations looking a little bit brighter, so some green shoots there. And then we'll look at the Empire State Manufacturing Survey. So this is New York. This is that very important region of the country that represents a major population center and a lot of manufacturing. Here we have manufacturing, which had kind of, again, just like we saw in the previous charts, protracted period of kind of a manufacturing rolling recession, if you will. And we had kind of like worked our way out of it. And latest data point here is slightly negative. New orders, really the same story. We're kind of like flat with just an intense amount of noise here over the last year. Now we'll look at PCE deflator on a 3-month annualized rate of change. So this is the preferred measure of inflation through the lens of the Fed here. In a chart that goes back to 1990, basically, you can see that the 2% target is outlined in red, and you can see that basically on an annualized rate of change just for PCE. Now, we just looked at CPI, and that looked like it was trending lower. The PCE looks like it's maybe moving slightly higher, a little bit closer perhaps to that 3.0% level that I think that we've been saddled at for a little while, at least on core CPI, or all-in CPI rather. Now we get into some demographic charts that I found somewhat interesting here, and then kind of talk about housing sector dynamics. So this chart from Apollo projects out into the future, and very interestingly, this is the first time I've seen anything like this, that it's actually projecting a peak population at 10.3 billion people in 2085, and then that population begins to roll over ever so slightly. And you can see here that population continues to expand. This has a lot of relevance when we look out at basically over the next 2 decades, and we get to 2045, and we're going to move from 8.25 billion people to something that looks a lot more like 9.5 billion. And it's got implications for infrastructure, for food, agriculture, and a lot of second derivative type industries. Another demographic chart I thought was very interesting is the number of families with children under 18 years old. And we've looked at fertility rates across the globe. Obviously China we talk about a lot, but the U.S. has declining fertility as well. And so this chart is saying that basically we peaked out at the total number of families with children under 18 years old back in 2007, and that's been in decline ever since. And so you think about that, and the replacement rate, needs to be like 2.1, 2.2, and lately it's been more like 1.8, 1.9. So we're not replacing workers as they're getting older, retiring, and then ultimately dying off. And this also has implications. So the supply of labor over time is in risk of declining because of these trends. Talking about net immigration, a lot has been said about policies at the federal level with regard to visas and permits and cross borders or border crossing shutdown, and so on and so forth. But we've seen a very notable decline. We look at 2024 to 2025, net immigration has really stalled out, and this has plenty of implications in a lot of different sectors, not the least of which being construction, agriculture, so on and so forth, but also some of the skilled labor areas as well, as you're not getting legal immigration opportunities there because visas are being cut and so on and so forth. Now that is expected to moderate, and maybe a number of immigrants maybe modestly increasing over the next several years, but again, nowhere near where it was. And so you think about, the growth in industries that tend to rely on immigration. And again, I'm not talking about the low or the semi-skilled. Well, I am, but I'm not talking about those exclusively. I mean, there's a lot of tech oriented businesses that benefit from that immigration as well. Talk about the median size of new single family homes. This is something I've actually talked about at a local level, being a member of the city council and kind of like understanding that this has some cyclicality to it. And I thought that was very interesting that, when you get into expansionary periods, you get average rooftop square footage that increases. So single family homes tend to get bigger as you're in economic expansion. That makes sense. And typically, in a case of a foreshadowing of a slowing market, that you tend to get a decrease in that square footage of those single family homes as you head into the recession, and then it picks back up again, and then obviously goes back down. What happened though in this last post-recessionary period was very interesting because we had all that inflation that was driven by a lot of the excess stimulus and money supply growth following the pandemic. But as a result of that, we had a lot of home price inflation, which made affordability go down, and it really put a cap on the average home square footage for obvious reasons. And that has continued to go down over the last several years. Talk about price to income ratio in the housing market. You can see that that's moving a lot higher because of price appreciation. Again, it just wasn't post-recessionary, post-pandemic, I'll call it. It's actually had sustaining power, and so this has become even more exacerbated. You've got rent to income ratios here on this side, those moving higher, and so you see, rents really coming down, and you've got people that are having to scramble, take on multiple roommates, live at home, so on and so forth. And you've got mortgage payment to income ratio for new mortgages remains very elevated, and you got to go back to really the kind of the area the time around the global financial crisis to see something this outsized. Now we got an article or a chart from an article by Goldman Sachs, and this was published back in September, and I just got around to kind of reading it here over the weekend. Very telling that it says that, listen, we have a housing shortage. We've known that really coming out of 2007, but here the estimate of the housing shortage by various pundits is that we need basically about another, call it 3 to 5% increase in the housing stock. And you think about all the issues that are incumbent with getting there. Obviously, you've got to have new builder incentives, and you have to have builders that have access to financing, and they have to have access to materials and components and really construction related commodities that aren't in short supply or don't have supply chain issues. And then, of course, you've got to have a supply of labor. And we just talked about the immigration issue. So you've got a deficit in housing stock to the tune of around 3 to 5%, depending on which of these that you believe, and that's actually rather significant. Now we'll talk about power and infrastructure, something that's been discussed a lot, with regard to AI and the demand for power that's driven by AI, and some of the innovation that's going into power generation, notably the small nuclear reactors and the portable nuclear reactors. And I think we're going to see a lot of development in that area over the coming years because of what this chart implies. So we basically have, peak supply anticipated that kind of moderates. We've got older plants, that need moderation, that need upgrades, so on and so forth. But then we have peak supply needed, and there's a very notable gap as we get into the next 10 years that's going to have to be supplied somehow. And that's why there's a lot of talk right now about the viability of funds that are investing in that type of infrastructure to help bridge this gap and meet that ultimate demand. Something else I thought was very interesting too. China is, spending a lot of money on infrastructure, spending a lot of money on power generation. The U.S., we certainly have regulatory bottlenecks and further controls on our ability to increase our power gen. You can see that the U.S. is increasing, but at a very, relatively snail's pace, while China is completely outpacing that. So when you look at, the number of just looking at it on this level alone, the number of data centers, well, the U.S. has by far and away the most data center productivity of any country in the world, even China. But power generation, which is going to be a real hot button issue over the next 5 to 10 years, is we're being outflanked right now by China. Now we talk about crude oil here heading into the winter months. We know the prices have been weak. This is, we get down to crude in the 55 to $60 a barrel range. That begins to crimp some of the economic benefits of drilling for a lot of the independent drillers. And again, it's not taking their profits away. It's just providing less of an incentive for them to drill and to engage in production-related activities. Having said that, though, our stocks within our 5-year range are very, very low. So the range would be anything within the shaded area. You can see that we're really hugging the bottom here, and we haven't done nearly enough to replenish our strategic petroleum reserves, as well as some of the other areas where we stockpile crude oil. So this gives me maybe some feeling that we're going to have at least some downside support at some level here on crude oil, and that we might get some positive activity out of crude prices coming in the months ahead. I've been trying to update you on some of the key commodity components out there, and these are a few of the notable ones. We've got aluminum, which of course, China is the largest producer there. Goes into a lot of electronics, a lot of construction, and you can see here that we've had a notable uptick here in aluminum prices. Again, they're just now getting back to levels that we saw in 2022. Shifting over here, we've got platinum futures. We can see that, kind of like gold and silver, we've seen a very strong rise here with high consistency there, because you've got a large number of consecutive days of gains here, relatively speaking. But again, those prices moving higher as well. You've got copper here, which is very important to the construction industry. I thought this chart was really kind of interesting, because you've got copper prices moving up like this. You see that in the white with the black shade underneath. But what's also notable, and also something that kind of fits into this narrative of rising copper prices, is declining production. So this represents a number of major copper discoveries, and you can see that that's gone down very dramatically in the last few years. We talk about food prices. You've got the CPI, the Consumer Price Index influence from coffee, and you also have the inflationary inputs from beef prices, which we know had been high. They'd come back down a little bit. Now they've gone back up again, but you can see, looking at them in the aggregate levels relative to, you go back several years, and pre-pandemic, they're much, much higher than they were. I want to spend a few minutes talking about the equity markets here and the derivation of returns by decade. In this particular chart, we have the S&P 500 index annual total return for particular decades. Now, this is not sequential, so I've got some data to show you here. And the key takeaway from this is that dividends are really important, and important more so in decades where you don't have ultra high equity market returns for that decade. And in some cases, dividends accounted for 2/3 or more of total return. And we do know that over, say, 50, 60 years, dividends have accounted for maybe about 35-40% of total return. So they do matter, and that's why we do focus on dividend growth and dividend production capability for the investments that we own. you can see in some years where you have outsized equity returns that dividends don't matter as much, which makes sense because you're probably getting more benefit from price to earnings multiple expansion than you are from the income component of that. But suffice it to say that no matter what decade you're looking at, and you've got the 2010s here, the 2020s, where we've had some outsized years in equity markets, that dividends still do matter, and dividend growth still matters as a factor. And you can, go back to the 1950s when the world was much more industrialized focus versus technology focus, where those dividends mattered a lot, even in that decade that we had and strong annualized returns. And if you look at 1940 to 2024, here is the graphic that really getting down to what I was talking about at the outset here, is that dividends account for at least a third of total return. I want to spend a little bit of time on dividends as a thematic approach for investing, and this chart helps to emphasize the chart that we just saw, that dividends do contribute meaningfully to overall equity performance. Here we talk about the risk aspect of that. And so we look at this chart. In the x-axis we have risk as defined by standard deviation, and on the y-axis here we have annual average total return, and obviously you want, in the grand scheme, you as an investor and your portfolio, we would much rather have much higher returns at lower risk levels, and that's actually what you get with those companies that pay dividends, who start dividends and grow those dividends. And you have dividend payers with no change in dividends, but the opposite of dividend growers and initiators would be those who don't pay dividends. And you can see here that they tend to have lower average annual total return. They tend to be a lot more volatile. And then, of course, the equal weighted S&P 500 index sits right in the middle here with the average total return of about 7.8% and a standard deviation of about 17.6%. For data that's going back to 1973 here. And so again, more fuel to the argument that dividends are important, and they do provide a risk-adjusted advantageous return. So we analyze, where the market is. Obviously, we know multiples are a little bit extended right now. Some of that is driven off of profits that are better than expected, and earnings that are better than expected, which itself is driven off of this right here. And this is the S&P 500 profit margins. And you can see trailing in the green line here, they've gone up, and the 12-month forward profit margin estimates again moving higher. So the market is kind of hanging its hat on this right here, this the darker green line here, looking into 2026. And I think the volatility risk is if we are not able to achieve these levels of growth and margin expansion. We've had a lot of money flow into equities, and in particular equity ETFs. And so we go back to several years and we've had strong inflows every single year, and with increasing amounts. And we've got the 4-year average daily inflow is about basically $5.5 billion, and again, moving higher consistently. I do want to spend some time talking about the Mag 7, and you have some of the notables within that group now up here. And just to level set, we do know that Google and NVIDIA, which is not in this chart, but those have been the two horses that have led that market. And NVIDIA has accounted for probably 35% of the overall market gain this year. So it's very important, even though it's not depicted here. But the risk is, and we can actually see this in a multi-quarter way here, that the free cash flow has actually gone down for these companies. And I think the story heading into 2026 is, can they kind of hold their head, so to speak, in terms of margins and profits, because these companies have been so important to the market in the last several years. Well, I think it goes without saying that we've had a lot of enthusiasm in the market, and I think this chart really kind of defines that. We have average cash levels for global fund managers. You can see right now, numbers down to 3.3. 4 to 5 is kind of like that band, and we were basically closer to 5% in cash in April, which is during the tariff tantrum, so to speak, but with this latest round of enthusiasm over higher earnings performance, higher earnings expectations, margin expansion, all the things that we just got through talking about, let's say fund managers are kind of all in right now. Their average cash level is very, very low, and they are certainly invested more heavily in risk assets. Now we have investor sentiment, which dovetails real nicely with the chart that we just saw. So obviously, people are more confident. They've got more money invested in the market. Their investor sentiment is extremely high, and you've got to go back to really July of 2021 to see levels where we were. You can see that the sentiment can change rather quickly, and right now it's coming off of the doldrums of the tariff tantrum here, but obviously that could change. And again, if performance is not up to expectation next year, we start getting first quarter, second quarter earnings reports that are falling shy, even if they're still growing, but they're falling shy of these growth estimates. And again, just to kind of remind you that the overall earnings growth expectation for the S&P 500 next year is kind of somewhere in that 12 to 14% range, which is better than most years, but certainly better than the long-term average. So here we have enthusiasm remains high, but obviously we're eyes wide open for shifts in that sentiment. Here we have the American Association of Individual Investors Sentiment Indicator, still very positive, bullish for yet another week. This is more of maybe I'll call it the institutional investors. So, and you can see that their exposure index is very high. We just kind of talked about that with fund managers and their cash levels being low. So, just a lot of optimism out there. Now we'll have a minute to discuss the fixed income markets. Here we have something I feel is definitely a positive development. We've got the 10 to 30-year yield curve. So this would be the difference between the 10-year Treasury and the 30-year Treasury. We can see now is about 0.7% or 770 basis points. You can see that illustrated graphically here, where if you back out kind of the near term and you look at maybe the next 1 to 2 years, where we still have that kink in the curve, that basically you kind of shut that out. You've got a upward sloping yield curve that admittedly flats out when you get to 20 to 30 years, but it's still upward sloping, which is normal, natural. It's symptomatic of a reasonable environment. It's just that you have maybe the expectations for further rate cuts that are built into kind of the more near end part of the curve, and so the expectation is the Fed's going to drop interest rates, which this little fish hook here is a little bit of an anomaly because usually you'll begin to have when the Fed is lowering rates, then that's usually in response to a slowing economy, which is not necessarily what we have now by any stretch. But yet you still have the market expecting rates to go down, and that's why you've got this little fish hook here, even though the economy itself seems to be working on working pretty well right now. Now we'll talk about some equity bubbles, and this is off of B of A Global Research, and I agree. The market can't move higher forever, and I've been around long enough to have heard this, this time is different a few times, and it really ultimately isn't. You can have changes in the market cycle, you can have extensions in the market cycle, but eventually you do have inflection points, and so this just shows you that that there's usually things that happen that cause a turn in the market, and this one is very important, that you have financial conditions which get tighter, right? And so when banks get more skittish, and the cost of like a consumer credit card goes up to the point where consumers just say, I can't afford to buy on credit and carry these balances. And, when you have these financial conditions tighten, that's usually, a sign of things to come here. And, we've seen this consistently. Again, we don't have any reference point for the 2020s yet for the Mag 7 related expansion in the market, but something to keep our eyes on for sure. So in this chart, we have the U.S. Financial Conditions Index from Augur, and you can see the conditions are definitely easier than they have been. In fact, they've been getting easy for the balance of this year thus far, with the exception of the tariff tantrum. But if you look over multiple years, you can draw a line of best fit that kind of like works like this. And so financial conditions may be still higher or tighter than they were, earlier in this particular decade, but they are definitely getting easier. So that does not lay the framework or the foundation for the type of inflection point in the market that we saw in the last chart. But again, this could change, and we want to be very attuned to any of those changes and what those implications could be. Talk about gold, which continues to move higher. This chart I thought was extremely interesting here. So this is out of Richard Bernstein's research. I think it's very good research. You can see that there is a positive correlation here. Maybe not so well defined basically before the pandemic, but certainly afterwards. That if you have gold year-over-year changes, gold's moving higher when you have greater uncertainty. This is the National Federation of Independent Business Uncertainty Index, which has moved higher, and you can see that gold is tracked with it, except for right now that there's, you've got gold that continues to move higher, and uncertainty seems to be falling right now because there's that increasing complacency that things are maybe not hitting on all 8 cylinders, but they're hitting on a good solid 6 or 7 of them. Odd to have this divergence, but the overall theme here is that you've got interesting correlation here between gold and uncertainty. We've got another chart from Richard Bernstein here. This is something else that I also am spending more time with. You've got crypto, and you've got basically crypto mapped against corporate high yield. And so you see the correlation here, and that's actually stronger than the correlation we saw in the last chart. So this would be essentially cryptocurrency versus the U.S. in a cross-currency rate environment, basically. And you can see that that's moving lower. We've had more volatility in crypto, and you can see that actually dovetails quite nicely with the corporate high yield option spread here noted in this chart. And it is interesting to note here when you talk about credit that we have an increasing amount of credit that's tied to artificial intelligence. We've got the hyperscalers that are expanding their capital spending. We saw a few charts ago that cash flow seems to be rolling over a little bit, and so we see a greater use of debt by the hyperscalers, and that's actually crowding into a lot of the issuance, and we have a lot of debt issuances now tied to artificial intelligence. So that's another area that, like, in addition to the equity markets, if we find some increased volatility related to slowing of AI or capital spending, it's not only going to impact the equity markets, but it's also going to impact option adjusted spreads in the fixed income market, and certainly could impact a lot of other things as well. Talk about the virtues of diversification, and this is a big reason why that you diversify across different equity subclasses, and notably, and in this chart we'll focus on international. You can see that these are major international indices, and you can see that basically all of these have outperformed the S&P 500 in 2025 in both local terms as well as in dollar denominated terms. And so you've got UK, China, emerging markets, you've got the Euro stocks, European firms, you've got the DAX in Germany, and you've got all of these areas that are basically, hitting on, several cylinders right now. And you see the total returns up here at the top, and then you've got the inputs into that. And so in many cases, you have very strong earnings growth, but you also have multiple expansion, which is something that we have been waiting for in the international markets. We've been looking for that catalyst to realize that value differential relative to the S&P 500. And then now we actually have outperformance in the international markets relative to the S&P 500. And I do think that that's going to continue for a while. Here we have value and growth dynamics. This is between the U.S. and Europe. And we've talked at length last time about how value versus growth is, value is definitely underperformed growth. And we do know that some of that's due to the Mag 7 and the rapid growth characteristics of those companies. But that, is beginning to unwind. But here you see U.S. value versus growth is really going south. But oddly enough, in Europe, it's going higher. And just at the same time, we basically had this divergence around the beginning of 2023. The value stocks, which are characterized by more industrials and companies that have strong financial condition, that cash flow well and pay dividends, that's what's kind of characterized here. Those companies, have some exposure to, to infrastructure spending and et cetera as well. And those are the primary drivers right now, oddly enough, where the U.S., we're getting most of the benefit out of growth right now. Here we have a couple of charts of interest to conclude here. We've got China exports to the U.S., not surprisingly, have gone significantly lower, I should say. We've had some very notable months or I should say these are really years, but the internals of this are actually pretty telling as well, because you look at on a quarterly basis and trade data, you can see very clearly that China is decreasing its exports to the U.S. and sending those elsewhere to other trading partners, whereas the U.S. is pivoting more and working a lot more closely with Mexico and Canada, despite the rhetoric and despite all the huffing and puffing from Washington about tariffs. And finally, here we'll conclude on this. This is as we enter the new year, what are the most pressing concerns for businesses in America? And you can see, differences going from the third quarter, which is in the light blue, to where we are today. And you can see that, trade and tariff was a really big issue in the third quarter, not so much in the fourth quarter. But demand, looking ahead, is much more of a worry than it was, and it comes in really second place here. Monetary policy seemed to be more of an issue last quarter. It seems to settle down now. We did get a rate cut, even though the Fed said, hey, I think we're going to be in hold for a while. At least that's an increased level of relative certainty here. So that fear has gone down a little bit. And really, when you talk about like things that are generating a little bit more fear, you've got labor quality, but this is not significant. So companies feel a little bit better heading into 2026. But if you look at it in terms of the percentage of respondents here, you've got trade, tariff, demand, labor quality, and to a lesser degree, what's going to happen with monetary policy and interest rates, being the primary drivers of the things that are keeping business owners and executives up at night. Well, I hope you've enjoyed the chart pack, and I hope you have a wonderful remaining holiday and be safe on the roads or in the air if you're traveling, and have a wonderful new year. And we'll be back in the first week of the year. Take care.